Hey, good morning, everyone. Chris Lopez here, and welcome to our webinar on should you keep, buy, or refi your rental property. This is a webinar that Lana and I talk about this topic a lot with our investors, our clients, other agents we work with, and it's a topic that's always on top of people's mind, especially in times like this where a lot of people are seeing high equity growth, high rent growth, and now we have high interest rates. So the classic sell, go to 1031 exchange, not quite as clear and cut and dry as it used to be. So I asked Lon to put together a presentation on 3 case studies so we could see how his mind works and goes through 3 properties. They're in the Denver metro market. We want people to ask questions and answers, or ask questions on here while doing this so we can answer them. We'll put Lon in the hot seat for a few minutes as well, have some fun. And the recording will be available afterwards. We'll make the slide deck available. Anything you need, let us know. We want this to be educational and also give you lots of great information on what you should be doing with your property. So I said, my name is Chris Lopez, and I got Mr. Lon Welsh as our host. Lon, how are you?
I'm fantastic. Thanks for having me today.
Yeah, this will be a fun topic. So everyone, hopefully you can hear us. Put your questions in the comments. And before we jump into it, I want to give everyone a quick heads up on a big event that myself, Lon, and a bunch of other team members are launching in about 2 weeks. And it's called our Portfolio Analysis Mastermind 2.0. It's a 5-week interactive mastermind to help you get a clear path to your real estate investing goals, both through active and passive investments. And so high level overview, week 1 is 5 steps to build your portfolio architecture. 5 steps to build your portfolio architecture. No, we can't do it. We're done. No,
got it. Okay, sorry.
Close it. 5 steps to build your portfolio architecture. And the first one is, what are your goals? What's your situation? 2 is analyze your global portfolio. 3 is analyze your individual investments, which is what we are doing today. And then 4 is explore opportunities via scenario modeling. And then 5 is create your portfolio architecture plan. So this all starts in a couple of weeks. And then the week 2, we're going to do live portfolio analysis with guests on there. Week 3 is part 2. We do more because there's about 3 or 4 common client avatars out there. And we're going to scenario every single one of those common avatars. And then we have 2 bonus webinars. One is supercharge your return with no increased risk. And 5, how to sell your investment property for a top dollar and reinvest it. And through all of this, in addition to all this, you get access to a free Property Llama account, which is our software that analyzes and models your portfolio. We'll do a private Facebook group to network, chit chat, and then also download a library of action templates so you can actually put into action what we discussed. So the link will be out in a few weeks. I'm sorry, in a few weeks. It starts in a few weeks. The link comes out tomorrow. It's completely free. If you can't make it live, don't worry about it. Catch a recording. But if you like the content today, you'll love this because this is basically the tip of the iceberg into what we'll cover
together.
Yep. And we're going to do it from the global view, which will be pretty sweet. All right. Lon, I'm handing you the keyboard.
Fantastic. Thank you very much.
We're going to make a transition here. So Lon is driving.
Too, I guess. All right, guys. Thanks for joining us today. We got a huge audience, which I'm really excited to see. So the goal of today's presentation is to understand how you can use active and passive real estate investments to optimize wealth creation over the long term. So something that I've talked about frequently in my investment classes and my investment books is that you need to reevaluate your portfolio all the time, because as the market environment changes, the optimal strategy is going to change as well. So something a lot of buy and hold investors don't usually think about is that every time a lease comes up for renewal and you decide to renew that tenant at whatever the market rent is that day, you are in effect buying the property from yourself at the market value of that property that day. And whatever that cap rate is on that moment, whatever that rate of return is that moment, you're saying that rate of return is acceptable to me when I sign this lease. So the market has changed enough that for many of us, that will no longer be the case. So I want to give you the intellectual framework to be able to make it an evaluation so you can make the best business decision for your properties. So as I go through this, if you have questions, please get in the chat box and jot down your questions, and I'll answer those as we go. So I'm going to do 3 different things here today. These are actual real examples. They're not just things that I made up. So this first one is a 2-bedroom condo on Virginia. This is a condo that I actually bought in 2012, I believe it was. I did a refinance in 2016, and I'm going to show you how the property looked to me in 2016. When I refinanced it, I basically recommitted that I would buy this property from myself at today's value. So we're going to look at that from this perspective.
Can I interject there?
Yeah, please.
Rewind, because what you said there, this concept took me like about a full year to really wrap my head around.
Yep.
Like you said, when you re-sign the lease, but especially when you refinance the property,
You're committing.
you're buying the property again.
Yeah.
Minus a few transaction fees.
Exactly.
And that's a mental shift that, man, when I understood that, I was like, wow.
Because you can always choose not to. You could decide, I'm not going to renew this tenant. I'm going to sell the property and take the proceeds and somehow reinvest it in a new way. And for the majority of the people on this webinar today, either a refinance or a sale is going to be your optimal strategy. Buying and holding with the current market environment for most people will not be the correct answer. And that's going to be like really new information for a lot of people on here. So this is just a generic, North Aurora, nice property, really well managed. You can look at the photos here. There's nothing sexy about it. It's just a good rental grade product. So if you can imagine a 2-bedroom renting for $1,200 a month, shows you how much the rents have changed over the last 6 years. So what I'd like to show you is a quick and dirty financial analysis. So we earlier did a webinar of a financial analysis with my more sophisticated financial analysis tool. This is the simpler one. It's so much easier to use. So I want to thank Joe Massey at Castle & Cook for having provided this to me, because it'll be really easy for you guys. You can download this Excel sheet and recreate it for your own properties very easily. So in 2016, when I refinanced this building I had owned for 4 years at that point, my parameters were, the value came in at 100 grand. I think my rate I refinanced to was 4%. I was getting $1,200 a month for rent. That's the tenant that was in there at the time. My HOA was $220 a month, which is a great deal at that moment for a 2-bedroom property. So you can see I've entered in all the data on here. I've got a separate webinar where I show you how to do a property analysis. I don't want to dwell on filling in this spreadsheet today. I've got a different webinar for that. The main point I want you to think through is, you see in the yellow box, I'm sorry, the orange box, after the refinance, I was going to have $325 a month of cash flow. And I was going to be able to pull out, I can't remember the exact number at the time, like $60,000 worth of equity or something like that. So it was a lot of cash to me at the time, at least. And you can see the cap rate at that moment in time was an 8.2%. So just as a quick reminder for people who are newer to this, a cap rate is, if you take our top line revenue of $14,400, that's our $1,200 a month of rent, minus our vacancy, minus our expenses, we get to a net operating income of $8,200. So if I paid cash for the property and I didn't have a mortgage, $8,200 would be my cash flow. But I've got this brand new loan. It appraised for 100 grand. I'm going to have a loan for 75, and you can see that my payment's there. So the cash flow that's remaining is the $3,900 a month. Below that, so that the cap rate is just the net operating income divided by that purchase price of the $100,000. And then you can see my 5-year rate of return is 21%, 20.9. And that incorporates all 4 methods of wealth creation with an investment property. So to recap those, there's the cash on cash return that you get every month. And that's like the part of the iceberg above the water that's easy for you to see. It's the long-term appreciation, and we're assuming 6% appreciation here. Why 6%? If you study the Denver market over the last 50 years, 6% is the average rate of inflation of house appreciation we've had in Denver over a 50-year time period. High inflation, low inflation, expansions, recessions, that's what it averages out to. The third method is, every time the tenant makes a payment, you're chiseling away at the balance of your mortgage. It goes down a little bit every month from the amortization. And finally, there's some tax benefits from depreciation. So that's the 4 ways you create wealth. If you take all 4 into account, this is going to give you a 21% return every year on a 5-year basis. Does that make sense?
It makes sense.
Got it. So,
but actually, most importantly, I want to pause there in the comments.
Yeah.
Does that make sense? Because this is one of those conceptual standpoints.
Yep.
That's very important. As I mentioned, it took me months earlier. A lot of this was by attending Lon Welch's and Charles Roberts' classes years ago in the Your Castle trading room.
Yep.
And I'd sit through the same presentation 5 times, and I would have that shift. So I want to make sure people understand that as well. So quick, if you guys have questions on that.
Yeah, do we have any questions so far? I want to make sure we answer them as we go.
These concepts are super important.
Yeah. And actually, every time you listen to this webinar, you're going to hear new stuff each time. There's so much packed into it. All right. So that was 6 years ago. So what does this investment look like today? Well, now the rents are $19.75 a month. So you can see 6 years ago, I was getting $1,200 for my rents. Now I'm getting $19.75. So it's a really important highlight here. The average rent has gone up by 65% in the last 6 years. The average price has gone up by 180%. So it's this disparity that we've witnessed in our market that's kind of upended all of our expectations about buy and hold. Buy and hold isn't the right strategy because the price appreciation has been so dramatic.
And so what that does is if rents go up by 65%, but prices go up, NOI goes up by 60%.
Yep.
And then so what that does actually compresses the cap rates.
The cap rate goes down a lot. And I'm about to illustrate that for you as you're leading the witness very effectively. So here is the same financial analysis for the exact same property from today's point of view. So instead of being worth 100 grand, now it's worth 280. It boggles my mind that this place could be worth 280, but there's all these sold comps for that. So if I bought this property today, I'd get a loan for 210, not for 75. You can see my rents are much higher. So if I bought this property today, and if I release it, I'm buying it from myself today for this set of economics. You can see my cash flow is negative $250 a month. So I've gone from positive cash flow to negative because if I bought it today and got a full loan, or if I refinanced it today, the rents have not gone up fast enough relative to the appreciation of the property for me to have positive cash flow anymore. So if you take a look at my cap rate, you can see it's now 4.9. Just to refresh your memory, it was 8.2. Now it's 4.9. So just like Chris was alluding earlier, the cap rates have gone down tremendously. That also means that our rate of return has gone down tremendously. You can see that I'm now at an 11% return instead of the 21% return that I had before. This is the ultimate first world problem. I've had literally like 15 or 20 years worth of appreciation in a 6-year period. This is a gift from the investing God. So we're all extremely fortunate. This will probably never happen to any of us again in our lifetime. So it was incredible to be a part of this. Does that make sense so far?
Yeah, it makes sense to me. Okay. I want to, we had a couple questions on here.
Yeah,
I'll loop back around to Chris, not Chris Lopez. Another Chris said, does $100,000 factor in closing costs you need to pay if sold? I think that was a purchase price, right?
Yes, I actually bought this in 2012 for 40 grand. So when I was doing the refinance in 2016, it came in at 100,000 on the appraisal at that moment in time. And there were some nominal closing costs, but they weren't very much. Good question.
And then Laura says, purchase price will be the appraised value and not the true purchase price, right? My rental appraised at 250, but I paid 185. Do I use 250 in purchase price?
Yeah, if you recently refinanced it and your current appraisal showed that the value was 250, I would run the analysis on the 250 value, because when you renew your next lease, you could choose to sell it for 250, or you could keep the cash flow for another year if you extended that tenant out.
Yeah, always use current value.
Always use the current value.
Yeah,
every time.
Ooh, this might be leading, but Michael says, so what is the new strategy? ...
Yeah,
your buy and hold doesn't map out. What's the new way to go?
Yep, I'll show you a bunch of options here. You're predicting where I'm going quite effectively here. So, so this shows you the rate of return if I did not refinance. So today, so my moment in time snapshot today is the property value is 280. You can see my mortgage is $42,000. So my mortgage has been going down over time, but now I'm getting the $1,900 a month of cash flow. And if I don't refinance, I'm enjoying $900 a month of cash flow. So I talked to one investor after another. I've owned my property for 4 years, for 6 years, for 8 years. I'm getting this incredible cash flow. I was only, what was I at originally? I was making $300 a month cash flow when I refinanced in 06, and now I'm making $930 a month of cash flow. So everyone thinks that this is a huge win and I've got the optimal strategy. It's not a bad strategy. You're definitely going to have like a great retirement, but we can do even better than this. That's what we're excited to share today. So if I refinanced and if I invested it with our National Diversified Fund, which we'll talk about at the end, our National Diversified Fund will return about 17% per year over a 5-year holding period. So one option among many is to refinance, keep the asset, refinance, take some of the proceeds, invest with us, and then see where you're going to be at in a couple of years. So the answer for you is the rate of return that we have on this investment now is 11%. Oh, sorry, 7%. That's right. So if I keep it and I've owned it for a while, my 5-year rate of return is 7.5%. So if we refinance, I've got some equity in my property. I'm going to be making 7.5% a year for the next 5 years. I've got the money I pull out from my refinance of 168. I could put that in the National Diversified Fund and make 17. My blended rate of return is now going to be 14%, a whole lot better than where I was before. So somebody was asking about what are the alternatives. So
sorry, I want to back up that one slide, please. Explain that again, because this was packed full of stuff here.
Yep.
So can you walk through the two different returns? You got the blended again, because I know this will definitely lose some people.
So if you just own this one condo and you don't refinance, you've got all of this equity that's tied up, and you're earning $900 a return on this giant investment. So your rate of return is relatively low. So the idea is we could do a refinance. We're going to pull some money out, and we're going to keep earning a return on the existing asset, but we're also going to be earning a return on the new investment that we make. So I just need to know what's my weighted average return between the existing condo I've had for a while and this new investment I'm going to make.
So that's basically, hey, you have $100,000 in the old in the current asset, then $200,000 in the new asset. You have $300,000 total pro rata.
Yeah.
Okay.
That's what we're doing. So we're going to leave 70 grand of equity in the old place. So why 70? It's worth 280 right now. I'm going to refinance up to 75% loan to value because that's what a lender would be happy to do. So that means 25% of the equity or 70 grand stays in. And then I've got like 45, 50 grand on my mortgage balance left. So the amount of equity I could pull out is about 168. So 168 gets invested at the new rate, 17%. 70 grand in the current property stays in there, earning the 7.5. So my blend is going to be about 14.
Perfect.
So what I'm doing is what we're basically doing is we're doubling your rate of return almost. We're going from making 7% on all of it to making 14% on all of it. So you're gonna make twice as much money basically with this strategy.
So we got some questions on here. I want you to answer before we move on, Lon. Justin says, does this include the cost of money you just pulled out?
Yes.
Courtney says, does this account for new higher interest rates?
It does. So let's go back and look at all that's really important. So if you look at the original view of this, we were on a 4% mortgage rate, which was incredible. So here, when we look at what if we were to buy it today, the mortgage rate I assumed was 7%. So yeah, we're taking a 4% mortgage of 40 grand and replacing it with a 7% interest rate of 210,000. So what you're going to experience is that your current condo, after you refinance, is going to have a slight negative cash flow, and you're borrowing money really cheap at 7%, and you're investing the money at 17, and you're capturing a 10% spread.
Great. That makes sense. And something else, because we've had a bunch of discussions now. This is a very low balance mortgage.
Yep.
Makes sense to refi the whole thing.
It does.
Now, if this was $1 million fourplex and I have a $500,000 balance at 4%, you may not want to refi the whole balance, but put a HELOC or second position on there to extract it. There's multiple ways to do this. Understand that. Lon just kind of doing the keep it simple, silly
this
route
is
right
the
now.
simple, and this is the worst case scenario, right? Like if you've got a lender, if you don't have one, email me, text me, and I'll introduce you to local lenders. The most preferred strategy would be, like you just said, is to keep the current 4% mortgage in place, put a second on top of it. But if that's an option for you, for sure do that. Your numbers will even be better than what I'm presenting here.
So a couple other questions. I think you answered this, but Monique says, doesn't refinancing at 7% negatively affect the returns?
Yes.
It affects the cash flow,
but
get the other returns.
Yeah, I modeled that. That's in the 7.5%. So the returns go down by a little bit, not by a lot. But yes, I did factor that in. Thank you.
I think all the other, Jackie, a similar question. And she said, can you do a 1031 exchange from a property into a fund? Unfortunately, no.
Regrettably not. Man, I wish I could solve that question, but we can't. So what are the options we've got here? So the first option is we do nothing. So we got a ton of equity. We make 7.5% returns. And basically what I did here is the compounding interest calculation for you. If your equity, today it's 240 grand, goes up by 7.5% per year, your gain in the first year is about 18 grand. Next year it's 19. Next year it's 21, 22, 24. By the time 10 years have gone by, the equity will have doubled. So today you've got about 240 grand with that itty bitty loan. 10 years from now, you're going to have about 500 grand worth of composite return. Does that make sense?
It makes sense.
So doing nothing is still a fantastic strategy. Nothing wrong with doing nothing. The second option is we do a refinance. So we showed you on the prior slide that we would get a 14% blended return. We would keep the property and refinance it, take the extra money, invest it in a national diversified fund at about a 17% return. If you do that, your equity is going to grow from 240 grand to 916,000. So just about twice as much as the do nothing strategy. So for many of you just looking for the easy button, well, this would be it. Refinance it at 7%, invest it at 17, and run the thing for the next 10 years.
So here's two people had this question. We're assuming a 17% return. It is not guaranteed. What if it's lower due to economic uncertainty? Great question.
It's great. So instead of being at 916, you'll be at 750, for example. You'll still be out probably way ahead in any realistic scenario. And we'll have a recording on NDF 6, National Diversified Fund 6. You guys can watch separate from this if you want. Will you have a link for that?
Yeah, we'll link to all that. And as we go through this modeling, if you guys want to do like much deeper dive into more of these nuances, hey, this second position loan or how's this cash flow exactly return, come join our portfolio analysis mastermind in a few weeks.
Yep.
That's meant to be a much deeper dive into that stuff. So we can't cover it all today, but make sure you come to that event starting in a couple of weeks, and we'll go into a much deeper dive on there.
Yeah, this is a lot of new information. We're going really quick. So there's, we'll go through all this with you individually. So the second option is the refi. The third option is, well, what if we do the stock market? I'm not a CPA, I'm a finance guy. So I did just a quick back of envelope. I think your tax liability would be in the ballpark of $36,000. You could sell it. You'd end up with about $206,000 available after paying the capital gains tax. The weighted average over the last 50 years for the stock and bond market is about an 8% annual return. So if you're sick of being a landlord, I'm just done with it, this seems like a great time for me to sell, and it is. What would happen? Well, my $200,000 of equity today would grow up to $450,000 in 10 years. So it's not quite as good as the buy and hold strategy, but it's very close, and you have none of the headaches of being a landlord and all the burdens that go with that. So for many of you, that might be a really attractive option.
No tenants and toilets, right?
No tenants and toilets anymore. So the next option is I sell it, but I put all the proceeds into National Diversified Fund. How does that turn out? Well, that grows me to about 990 grand. That is the best option, but frankly, it's only a little bit better than the option of keeping it and doing a refinance. So for most of you, from the diversification standpoint, if you're not burned out on being a landlord, I would do the refinance option. If you're sick of being a landlord, I would sell it and I would do option number 4 and invest it with us. But the most optimal strategy is going to depend on kind of where you're at in your investor life cycle and how much you like this particular property. If you've got 6 different rentals, everyone out of 6 will always have one that, this is not my favorite building. I'm kind of done with this one, but I like these other ones. So what you may do is you may refinance a couple and sell a couple, and that'll be just your unique strategy.
And the reason option 2 and option 4 work so well is because it's using leverage.
Yes.
That's the underlying wealth building factor in here. It's why we're getting such better estimated returns with those two.
Yep.
It's because we're employing leverage, which you don't get in the do nothing, the stock market, the DST, but leverage and real estate go hand in hand. And that's what gives us these great double-digit returns.
Yeah. So the thing on leverage, if you can borrow at 7, if you can invest for anything more than 7, then the leverage is going to help you out. Basically, think about like what do banks do all day. They borrow at 2 or 3%, they lend out at 6%, and the spread between those two is 3 or 4%. That's how banks work. You can basically be your own bank. The last option on here, I'm not going to spend much time on it. It's called a Delaware statutory trust. So you can sell an existing asset and do a 1031 exchange into a DST, and they run everything. It's totally hands-off, totally passive. It just doesn't pay very much. So if you did that, it would get you out of the landlord game. Your wealth would grow from 240 to 395. Still pretty solid, but not as good as the other options. But I'm usually asked about Delaware statutory trust, so I wanted to make sure I included that for you for completeness sake.
And a big reason I think DSTs are so popular is that you can do a 1031 exchange into them. And it's basically kind of like very similar to a fund where you're a very limited passive investor in there. So it's very sexy. Oh, I pay no capital gains, but this is where the modeling comes out. Yeah, you're putting more money in today, but it's compounding at a lot slower rate.
Right.
So yeah, in years 1 and 3 you're probably ahead, but after years 3, you start trailing the other opportunities.
Yeah, it's I think everyone has this innate hatred of the IRS, so I'm not going to pay a dime more than I need to. But we did a separate webinar a couple of weeks ago where we showed that a lot of times selling your existing asset, paying the gains, and then reinvesting is actually a superior return than the options where you're doing a 1031. Super counterintuitive, but we did all the math for you on that episode. Did you get a couple more questions?
Yeah, a couple questions here. Molly says, how do you factor in what the capital gains taxes are when you pay with investing?
Yeah, so if you take a look at about the second line, third line down, capital gains, if I sell now, I did just a quick back of envelope to try to guesstimate what the gains would be. So you'll have this exact spreadsheet. You can download it. If you happen to know, or you could talk to your CPA, hey, I've had this property for 7 years. Here's my parameters. Your CPA could tell you exactly what your gains liability would be, and you could pop that number in there instead of my number. And for your scenario, then you'd populate all the answers and you'd reflect that.
Christy asked, so why invest the second in a position of equity into the fund versus buying another property?
Great question. I am so glad you asked that. So this one is it Christy, right?
Yes.
So Christy, what this one is looking at right here, the slide I've got up here is the slide we looked at a second ago. This is that property from the today point of view. This is with the low mortgage. Do I have it with a high mortgage in here? Yeah, I'm sorry. This is the slide, Christy. This is the one you want. So this is a 280 purchase price today. I've got a mortgage of 210. So I'm putting $75,000 down. So what you could do is you could refinance your existing property and keep it. You get $168,000 out, and you could buy 2 properties like this one and use the 168 of proceeds, put 75 grand down on each one. What you're going to find is that they're going to be slightly negative cash flow, but that they're going to have a rate of return that's positive over the years. So that's completely an option for you. It's not going to be as good a return as the investing in National Diversified Fund 5 today, but that will change. Like, this is the best option for today. 2 years from now, we may find that things are different and that buying real estate and managing yourself is a superior option. I actually believe that's going to happen. I just don't know when that's going to change, but at some point it will.
A couple of things to add on there too is it's there's like the spreadsheet math, and then there's like the reality of it too, Christy, of like, hey, sometimes that higher debt service, that's going to knock out some people who will qualify for a mortgage,
right?
Or now you have a negative property with negative cash flow. Are you okay with that?
Not everybody will be.
Or you do a lower refi, so you're at a 60% LTV to stay at a more comfortable and safe refinance.
Yep.
So there's lots of levers on there.
Yep.
And sometimes it just depends. You know what? I'm busy right now. I'm starting a business. I have kids, whatever. Like, there's so much more context on there other than just the pure spreadsheet returns.
Yeah. You want to take all your lifestyle. Does your spouse enjoy the fact that you're managing this property on the weekends? There's a lot of things that go into it. Okay. Other questions?
Yeah, here's an interesting one. Then I'm going to skip some just for the sake of time. We'll answer afterwards. But Joanne said, I sold a fourplex in August, made a very nice profit with the intent to do a 1031 exchange for several properties in Florida. Hurricane Ian changed those plans. Sorry. And I could not ID the properties. So now I'm looking at $130K capital gains tax obligation. Would the NDF fund help reduce this tax liability?
No, nothing will reduce the tax liability. If you were going to do a 1031 and you're out of your 45-day identification period, you'll just have to pay the gains tax.
Let me ask you this question, because I've had some interesting scenarios like this other clients, Lon. So they still get the gains.
Yep.
But what if they invest in another property, or like say a single asset where they do a cost segregation study, bring up a lot of depreciation in year one
to offset the gains?
Couldn't that depreciation help offset some of the gains?
Yeah. So, wow, you said a lot in one sentence.
Yeah, sorry.
No, that's okay. So for the guys who are newer to this, one of the 4 ways we create wealth with owning a rental property is the depreciation tax benefit. We did a separate class, actually a webinar, talking about what depreciation is and how to use it. And there's a strategy called cost segregation that will legally allow you to take more of this tax write-off more rapidly. So for more advanced investors, that's absolutely a strategy that could be a great fit.
And I think that was Joanne that said that. Joanne, that bonus webinar I mentioned, the PA Master, the Portfolio Analysis Mastermind on the maximize your returns.
Yep.
That's all about depreciation. Make sure you check into that, and also send me a message offline here. I can have a discussion on that sooner rather than later with you, since the clock is ticking.
Yep.
I see a lot of other questions in the chat in here that are very personalized to the investor. I'm going to put those on hold for now, just for the sake of time. And again, for all these specific personal questions, guys, talk to me a lot or come to our mastermind in a few weeks.
Schedule time to talk to us and we'll walk you through all of it.
Yeah.
Absolutely. This is great stuff.
I would say, yeah, let's keep going with the other slides.
Okay. So case study 2 is just a slightly different spin on this. So this is when I bought Virginia, the same condo, when I actually bought it in 2012. So what I first did is I did my refinance event at 2016. Let's take a look at it from 2012 just to see how that changes the numbers. The answer is not very much. So I actually bought this for $40,000. So my mortgage originally was 30 grand. Only First Bank was willing to do that. I think I paid more in friggin' setup fees with them than I paid for like interest. At the time that I bought it, a 2-bedroom was renting out for $950 a month. So you can see that's on there. And I had $400 a month of cash flow. This was a 16 cap. Those were the days, and I miss those greatly. So you can see my after-tax return when I bought this was 38% per year. That was assuming 6% appreciation. As you guys know, this thing went from 40 grand to 100 grand in 4 years. So it ended up being a little bit better than that. So from today's point of view, it's the same cash flow, right? My rent's the same, my expenses are the same, but my cash flow is a little bit higher because I'm working with my original loan of $30,000, which is now paid down to like maybe 20 grand or something like that had I not done the refinance. So you can see my 5-year return is a little bit lower on this because I have so little leverage. The less leverage, the lower the returns. That was my main point of going through this slide. So for those of you guys who just bought a rental property 3 years ago, there won't be as much of an opportunity for you to capture upside by doing the refinance. For those of you guys who've been in properties 5, 7, 9, 10 years, it's a gigantic opportunity. If you've not done a refinance, you've got all this equity, redeploying it's going to give you a vast increase in wealth creation. Does that make sense?
It makes sense. And sometimes, if depending on the cap rate, if it's like, you know, a house in Wash Park or a house in the Highlands you bought 10 years ago, you're probably better off selling it versus refinancing it. Yeah. So it gets more nuance in that, because if the cap rate really got compressed, take the appreciation, put a smile on your face, but sell it and reposition the money. Yeah, sell it, pay the capital gains. It's not going to be the end of the world, and you're going to come out way ahead. And we've got a whole webinar walking through all that logic. Okay, let's do a house because I wanted to do one of each. So this is a house that I bought in 2013 as a short sale. Back in the days when you could buy a 4-bedroom house in a great school district for 165 grand. It just sounds like a friggin' fairy tale to me now. Did you buy this in Pueblo, Juan? No, this is Littleton. This is in a great school district. Killer area, nice neighborhood too. So I put 18 grand into it, granite and stainless. That's when I could find contractors. They would call me back. I just miss these old days a lot. So if you could believe this, my 4-bedroom house rented for $1,600 a month at the time. So here's in 2013 what that math looked like. And there's probably a lot of people on this webinar say who can really relate to this. So they probably got their own Johnson way in their portfolio. My loan was $123,000. Initially we got $1,500 a month for rent. As we rented in the winter, we didn't get as good a tenant to get started. There's my operating expenses, and I had like $350 a month of cash flow. And you can see my initial cap rate was a 7.6%, and I probably borrowed here like 4.5 or something like that. And my 5-year return is 15%. Is what I thought when I bought the property. Turned out it appreciated better than I thought. So what's it look like now? So today this place would rent out for $3,100 a month, or double. So the rent's almost doubled. So the rent's up 107%, and the price is up 235%. So once again, it's just this gift from the investor gods to have taken part of such a rate of appreciation. But when that happens, cap rates compress. The cap rates drop a lot. Yeah, no doubt. So this house would probably sell for $555, $560 today. I bought it for $160. It's just even hard to comprehend the numbers. So if I bought the property today, and I kept my old mortgage, my mortgage would probably be down in the 80 grand range because I've paid down a lot of the mortgage. My rents are higher. My taxes more than doubled. My property insurance is quadrupled.
So you can see my cash flow now is about $1,700 a month. So a lot of you guys are probably sitting on houses like this saying, I'm doing great. If I re-rent it today for $3,100 and I say it's okay for me to have all this equity trapped in my house, my 5-year rate of return is going to be about a 7%, because I've got a huge equity position in here, like 400 grand or something like that. So what could I do? I could refinance the property. I could pull out about 300,000 in cash. I could redeploy that 300 grand in cash invested at 17%. My weighted average is going to be about 14. So what are my options? The first one is do nothing. I've got 480 grand of equity sitting in here. It's going to grow to about 960,000 over the next 10 years. Pretty great. I could refinance it, redeploy the cash that comes out of the refi. I'm going to have $1.8 million worth of equity, or almost twice as much. I'm sick of being a landlord. Option 3, I could just sell it and put it in the stock market. I'm going to end up with about 900 grand of equity, almost the same amount if I just do a buy and hold. So just like we found on the first property, if you're sick of being a landlord, you just want to sell it, pay the gains, put it in the stock market, you'll do just about the same results with a whole lot less headache. Or you could sell it, pay the gains, invest all the proceeds in the diversified fund. You get about $1.96 million, a little bit better than the refinance, but not a lot. So if you're enjoying being a landlord, keep it and refinance. If you're sick of being a landlord, just sell the thing outright. And then the Delaware Statutory Trust is like a no-go.
So I think this is the one, if you guys have a question on there, pulled up, but we also did an audible about 5 minutes before the webinar at some point to actually show a modeling with the...
yeah, how do I pull that up?
Let me
I'll hand this over to you.
actually.
1 second, guys. We'll bring that up for you.
Let's see, where's the mouse at? There we go. Mouse decided to start working again. All right.
So what I wanted to run for you here is, let's pretend that you don't own any rentals right now, and you've got cash available and you've gotten pre-qualified for a loan, and you're thinking about buying this property on Johnson Way for $560,000. So your choice is, I could either buy the property today, or I could put the money in the passive income fund. The refinance option doesn't make any sense because you don't own it. The other option is you could take your money and drop it in the stock market. That's always an option too, right? And the Delaware Statutory Trust wouldn't apply either. So really we have 3 options if you just have cash. So our first option is we're going to buy it today. And with the rate of return that we've got available, our money's going to grow to 300 grand worth of equity. The next option, is there a way I can shrink this? I don't know how to use a Mac, so I apologize. Just so it kind of fits on one page.
Yep, I got you here. Sorry, everyone, the mouse is not cooperating today.
Sorry about that, guys. Just 1 second here. There we go.
Is that better?
Yes, perfect. So our second option is we're just going to take the 150, drop it in the stock market, and assume that we get the 50-year average return that the stock and bond markets have returned. That gives you 326 grand. It actually makes more sense for you to drop the money in the stock and bond market than it does for you to buy this house with the market conditions as they are today. And as a guy who's been a full-time real estate investor for 20 years, it pains me to say this. But that is the economic truth that we have to share. The next option is you put it into the diversified fund. The money will grow to 720 grand over a 10-year period. The DST wouldn't be an option. So I just want to show you kind of the current market environment we're in, what your alternatives would be today.
And to, again, when we look at this stuff, I always view these discussions, it's an onion. Yeah. As we've already seen on here, we've gotten so many questions. Hey, we could do this. You peel back that layer of the onion. Oh, what about this? Peel back that layer of the onion, and so on and so on. Because, this is where you have to do a deep dive analysis, talk with your whole real estate investing team, your CPAs or lawyers, because a big difference on, hey, if you refinance, that is not a taxable event.
Yep.
If you sell,
it is taxable.
That is a taxable event.
Yep.
And that's where you want to understand, hey, what is that actual taxable event like to you? But if you look at a refinance, what does the higher interest rate do to your DSCR, or not your DSCR, your DTI, your debt to income ratio for most of us? And so it gets very layered on here. So again, our goal of this webinar is to give you guys the high level overview and leave with the concepts that, hey, if you're sitting on equity, sitting on a rental property, lots of equity in there, you're sitting on an untapped gold mine.
Yes.
And we want you to understand the options out there that you have and also with the current market conditions. Because for some people, especially if you're later in your investment cycle, for a lot of you might be like, you know what? If I just paid off this property a $70,000 mortgage balance, I hit my cash flow retirement goals. I'm done.
You're done.
Fantastic. Congrats.
Yep.
For a lot of us, myself included, that's not the case. I'm in acquisition mode. I need to leverage up.
Yep.
So hopefully this gave a lot of concepts out here. And again, if you want the individualized help, reach out to me and Lon. But most importantly, make sure you come to that portfolio analysis mastermind. We will have hundreds of investors and lots of professionals here talking all sorts of options. And it's going to be one of the best ways to learn. So should we jump into some more of these questions here, Lon?
Please. Yeah.
So Erica says, what in option 2, and this is the refi one, are you pulling money out and buying something else, or what are you doing with the money you pull out?
Great question. So if you take a look, I'm going to highlight this for you. So when you do the refi, like, actually, you know what the better way to do this would be? Let me switch back over to the PowerPoint. You take it, let's do this to make it really easy for everyone to focus. I'm going to go back to the Virginia study. When we refinance the condo on Virginia, we'll have 70,000 of equity still left in the building that we're holding on to, and our rate of return on that's 7.5% a year. And I've got 180,000 that comes out tax-free from the refinance event, and I can invest any way I want. So I assumed for you that we would drop it into the National Diversified Fund. The other options are you could put it in the stock market and bond market, or one of our earlier ladies asked about, well, could I just buy another property just like this one? Absolutely, you could do that too. All of them are great options. Anything where you refinance and redeploy the cash is going to be a better answer than leaving the cash trapped in the building. Doesn't matter to me which something you do, as long as you've thought through all your options.
Yeah, you have to make the money work for you.
It has to be some return more than your rate of borrowing. So if I'm borrowing at 7, anything I invest in more than 7 will create wealth.
Yeah, but if I'm borrowing at 7, getting 8% return,
it's kind of
probably not worth the hassle.
It's probably not worth the headache.
But if I can get a 10% spread, I'm going to take some risk and I'll deal some headache.
Exactly.
So that's where it comes down to your personal risk tolerance as well, and all sorts of these factors.
Was that Katie who asked that?
That question?
Yeah.
That was, I think, Erica.
Oh, Erica.
Yeah.
So Erica, if I didn't answer that all the way, put another question on there. That's really important that you guys all understand that. So I don't want to like gloss over it.
Cool. I'm going to start running through some of these questions here. So Ashton asked, what if you already refinanced and have a low rate under 3% currently on investment property? How does that change your options?
So, well, what it'll do is it'll make all your options better. So if your primary is at like your first mortgage is at 3%, and he's got some equities. Let's say you did that refinance like 4 years ago, and the value of the property's gone up by 50%, which probably wouldn't be unrealistic in a 4-year period. The most optimal strategy would be for me to give you a contact like a Bank of Colorado or First Bank, and they could do a line of credit against the equity in your property. You keep the 3% facility currently in place, and that line of credit maybe like a 7.5. The most ideal situation is the line of credit is the loan is set up, but they don't advance any money to you until you want it. So you can wait until you either find a property to buy or an investment with us or buy a boat, whatever you're going to do with it. But then you're in complete control of how that works out. And I can make those introductions to banks if you want.
Yeah. And I mean, I've done a strategy myself. Like my primary residence is at a 2.5% 30-year fixed rate. I don't want to touch that.
Exactly.
But I put a HELOC on there, and I've got a basic like a 5% teaser rate for a year. Then it's prime plus a half point.
Perfect.
Well, I can go out there when I need money. I can pull out $25,000 or $100,000 or $200,000 and go invest it.
Yep.
And so that's the same concept on there. So again, very nuanced, but reach out. We got a bunch of lenders, different options on there.
And for some of the guys on the webinar today, this all applies to commercial as well. So for example, a lot of you guys have been here to see us in person at our office on Locust Street. I own this building. It's currently worth about $5.8 million. My mortgage is like $2.4 million. It's a great loan. It's like at 4.2% locked for 10 years. So I was able to go to a local lender, get a line of credit for $1.5 million at 6% on the building. And then I was able to go redeploy that equity, which is great. I put it in the short-term income fund. So I'm making 11, I'm paying 6. So I'm making 5% on the spread. Like it's fantastic. I feel like a bank.
So Erica has a follow-up question. Lon, on the spreadsheet, when you show option 2, it is similar or a slightly less return than the NDF.
Yep.
How are those numbers calculated? Just based on the return on that first property, or also redeploying the capital that you pulled out?
Yeah. So great question. So for option 2 on the refinance, what we're looking at there is you're going to pull the cash out. And then what I chose for you is that the 180,000 that you take out of this, you invest in National Diversified Fund at 17, and your weighted average return is now 14. Let's pretend instead that you decide I'm going to go buy another property with the money instead, and that my rate of return is going to be 11%. What you would do is you would change that 17% to an 11%, and now the blended IRR is going to be, let's say 12 and a half. That's probably pretty close. And then can you highlight kind of where it says like 14% on here?
Go back one.
Here we go. So if you put your cursor right about there, if you guys can see that, you would change that 14 to be 12 and a half. And then you would see if I refinance my property, take the proceeds, buy another property with it. So now I've got 2 properties. What would that do? And that's how you'd be able to exactly figure it out. So for a lot of you guys, like one thing we haven't talked about today is that we're assuming you're just going to buy a nice property that's ready to rent. You may decide to buy a nasty property that's a fix and flip, renovate it just enough, renovate the thing, but now you got a ton of equity in it. Those returns are going to look better than the guy that buys the rental property that's ready to go today. If that's a type of strategy that you like, refinancing and then doing that is probably going to be better than investing in a passive investment. Because if you're going to put the sweat equity into it, you're probably going to do better. You should do that, and we can help you model all that out.
Of course. Another thing to look at too is, I mean,
does she have like a part B on there? Of that question?
Just based on the return of that property one, or also redeploying the capital you pulled out. I think you got.
Yeah, I think we answered that one. If not, let us know how we can.
And like Lon said, like, I think we use that Johnson way to high 4 cap rate. If you go out there, buy a value add property, or go buy a short-term rental, or go down to Pueblo, you can get better cap rates or better yields as well. So make sure, like, again, we're modeling stuff out for you.
Right.
Make sure you understand what type of properties you want to buy. I love short-term rental numbers. I don't want to own a short-term rental.
Right.
Not my alley, and I want the headache.
Yeah. There's a continuum of being an active investor, right? You could buy a long-term rental and have a property manager that's the least active investor, or you could be the guy that I'm going to buy a fix and rent in Pueblo, really active investor, and hopefully you make twice as much money. I hope you would, at least, for all that extra.
So Robert says, can you share the spreadsheet? Yes, we'll email it out after this webinar.
Yep.
Victoria says, can you please share your investment line of credit lenders? Yes, we'll include the email afterwards as well. Yeah. So we'll kind of put that in
what I'd like to have you guys do is contact me directly on the lenders, and I'll do an introduction so they know to expect you.
Perfect.
So it's not blind. It'll be a lot more effective for everybody that way.
You're absolutely right. Nathan says, where can we sign up for the Portfolio Analysis Mastermind 2.0? The page will be live tomorrow or Wednesday at the latest, so stand by. You'll get a few emails about that, Nathan, when it's ready to go for sure. All right, going back up to some other questions here. Here's a great question earlier. So Tom says, does your projected IRR assume that you'll sell in 5 years? If so, how can you talk about a 10-year gain?
Yeah, what we're doing is a 5-year economic model. And I go back here. So this is a simple 5-year economic model. And what we've got in here, I believe, is that the rents are going to go up by 5% per year. If you look at the last 40 years in Denver, average increase for rents is 5% per year. So that's why I picked that. I think I picked appreciation here of 5% per year. The long-term historical is just over 6, so I was a little bit lower than that to be conservative. I think I assumed that all the operating costs would go up by 3.5% per year for inflation. So those are the assumptions that we used. So then using that math, the 7.3 return after all the taxes are paid are assuming that you run the property with those assumptions for 5 years and then sell it. And I think I put in 5% or 6% for your cost of sale at the tail end. So for the 10-year projection, what I'm doing is I'm just assuming that this 7.3% is the same return that you'd get for years 6 through 10 as well. If you actually take the trouble to model it on a really long-term basis, that'll actually be very close to the reality. It's just a simplification step.
Great. So we got a bunch of questions we'll loop back to, but Lon, can we pull up that last slide? Because we have some questions about just some of the funds themselves. Let's kind of go through this and jump back to the slides. So I'll do that first block there, the Portfolio Analysis Mastermind. Registration link will be out in 24 to 48 hours. It's free. We want all you guys to come join it. So definitely come attend that. Now, Lon, I'll let you talk about the next 3 tiles on there.
Yeah, so there's 4 types of investments that we've got available at the moment. So the first one's not on here. It's called the short-term income fund, and it's very liquid. So you can invest money in this and make somewhere between a 7 and 8% annualized return. So you get just about a 2% dividend every quarter. When you need the cash out, just give us a couple months notice. Usually we could do it in less than a month that you need the money, and we'll return the money to you. It's invested in a whole bunch of hard money loans, and we have a different webinar that talks about that in depth if you're curious. So if you've got cash reserves that are making 1% at Wells Fargo, this is a great option for you. It wouldn't make sense for you to refinance into it, because if you're going to borrow at 7, invest with us and make 7, that's not going to make any sense. But for other uses, for most of you guys on the call, that makes sense. It's only a $25,000 minimum. The National Diversified Fund is the one that for most of you will be the one that makes the most sense. That will be buying about 25, 30 different buildings and about 10 projects across a number of states, probably 6 or 7 states, some multifamily, some industrial, some self-storage, a good blend of asset types. About half is renovating an existing property and adding a lot of value. The other half is building from scratch. So Fund 1, which we did back in 2019, is tracking to a 21% annualized return. I think we'll be a little bit less in Fund 6. We'll probably be in the 17% range. But you can see that what that looks like there. So to borrow at 7 and invest at 17 is a great thing.
2 things about that is that's usually an illiquid investment. Your money's tied up in there.
Your money's tied up.
That's why you're getting a better return.
Yep.
Because it's not liquid. Second, I come back from a finance background. National diversified funds, very similar to like how a mutual fund is structured for stock investing.
Yep.
We put our money into one pool. Then you have the Ironton Investment Committee, which is Lon and a couple other team members, go out there and invest it based on the criteria. So they do the heavy lifting. You get to invest. So I always think of that as like a mutual fund for real estate.
Yep. So for those of you guys who have been listening to us for a while, we just finished raising money for Fund 5 recently. Something new about Fund 6 is that we'll have 2 different share classes. One class will have a lower preferred return and it gets all the depreciation. The other class will have a higher preferred return, but no depreciation. So if you don't need any extra passive losses, we could put you in a share class where you'll get a higher preferred return. If you do need things to offset your passive gains, we can give you probably almost double the amount of appreciation you would have gotten otherwise, and your pref will just be a little bit lower. So that's something new. And if you're curious about the tax optimization, talk to us. We'll help you think through that with your CPA.
The third one's going to the Denver apartment renovation.
Yeah, so the National Fund is all over the U.S. These 2 are based in Denver. So if you're the person who likes to see the properties, we're actually going to do educational seminars on site of both properties periodically. So if you want to learn about how to renovate an apartment building, this would be a great way to learn from a really experienced operator. His name is Terrence Doyle at Bearco. So the apartment renovation is in Westminster. It's a 34-unit building. We're going to renovate every single unit plus the common areas. It should be a return in the 13 to 19% annual rate. Should take us 2.5, 3 years to do that one. So that'll be appealing to a lot of you guys.
And I want to jump in here. Joanne, I think that was who sold the fourplex and had a failed 1031 because of Hurricane Ian.
This might be a match.
This might be a good one to help like offset some gains.
Yeah.
If I forget to follow up with you, please message me as well, Joanne or Zach, if you can help out that as well.
So it's funny when I talk to investors, some have a real love for the diversified fund. Some really just love renovating existing. Some really love new development. Everyone's got something different they like, which is great. So if you're more of the new development side, or that's something you've always been curious about, you can invest in the new build townhomes. We're going to build 10 new units right next to a light rail station at about 13th and Lowell. I'm actually a co-general partner on that. So my last townhome project was like 3 blocks away. My partner on this has done, 6 or 7 different projects all within a mile of here. So we know the area really well. It'll be just like the apartment renovation where we do seminars on a pretty regular basis on site. Here's what the contractors are working on now. Here's the problems we ran into. Here's how we overcame them. Here's the issues came up with the permit process. Here's what we're doing at the bank. If that's of interest to you, invest along with us. You don't have to come if you're not interested. We can just send in a check and we'll send you a check back. But that's also an option. That'll also be a 2 or 3 year commitment. Probably in the low 20% range is where that will come out.
Awesome. So if you guys have any questions on these, reach out to me, Lon, Zach. We can get you a lot more details on there. But I want to go back because I know we had a bunch of questions earlier. I wanted to circle back around to those since we have 5 minutes left.
Lots of great questions today. My goodness.
Yes. So this was a question Jeff Holloman asked. He said, if you go the DST route to avoid cap gains because you ran out of time to find a replacement property, can you pull the money out quickly to buy a rental when you find a good replacement? I've never done a DST, but a few I've looked at, I don't think you can, but I don't know.
I've never done a DST either. I've talked to a lot of guys who have done them, and they've all been frustrated at the fees and how locked up they are. It would depend on the DST, but I don't think most of them will give you that kind of flexibility.
I think it's basically like, you're buying a fractional share in there, and
right.
you're locked in there until there's a sale event or a refinance event, is my understanding.
Right. So a way to deal with this, it wouldn't be with your refinance proceeds, but we have an investor who I met with a week and a half ago who does a lot of fix and flips. And he's very frustrated with the current market conditions. So he's going to liquidate his last 2 fix and flips that are almost done, park all that cash with us in the short-term income fund, and make 7.5% for the next 6 months, 8 months, 12 months, 18 months, until he likes the market conditions. And he'll liquidate out of short-term income and go back to his fix and flip career. But it's just a way to wait out the storm with the market conditions that we're in right now. So that might be applicable to you as well.
Yeah. Penny asked, what do you think about a portfolio loan to leverage current rentals to purchase more rentals?
Currently, if you can find a cap rate or a blended 5-year return, like above, say, 12%, because maybe they're like value added things you're going to buy, that would be my preferred strategy if I still enjoy being an active investor. But I'm having a really hard time finding any returns that high in this market.
And Penny, I don't know, do you mean like a blanket loan across multiple properties? That's the way I interpret that question.
Yeah.
It was like, if you have, like, say, 10 single family homes and condos, and they're all like a 50% LTV. I've seen a lot of investors, actually had one like 3 weeks ago, put out they call it like a blanket loan across 5 properties, wrapped up the one loan. He pulled out $500,000, bought a fix and flip, under contract, another rental, put some money into one of the NDF funds. And so you can definitely get creative like that, depending on your situation, your portfolio.
Yeah, that when we talked at the very beginning about that condo I bought in 2012, and by 2016 had gone up so much in value, I actually had bought like 80 condos like this. So I got blanket loans, just like you said, in 2016 against all of them, got a huge war chest, and went out and bought a whole bunch more, which still worked out really, really well.
All right. Someone said, can you invest via 401k into funds?
Yes.
Yes, you can. Again, it has to be like a solo 401k or self-directed 401k, and we can give you some good.
If you need a
trustees.
self-directed, custodian, we can recommend those to you. It also works with self-directed IRAs. So usually for you guys in that case, you would prefer to get the share class that has the higher preferred and no depreciation, because you probably don't need the tax benefit within your self-directed IRA. So we actually engineered this product with you in mind.
Here's a great question from Steven. How does the NDF returns change with the economic slowdown and slowing housing market? Additionally, how do economic changes with more apartment inventory coming into the market?
2 great questions. So we talk about this a lot. So I'll give you a short answer now, and you can listen to the NDF 6 long form where we have a lot more time to talk about that. What we're finding is that very attractive large apartment complexes. We just finished one in a suburb of Dallas in Fund 1, and we sold it 3 months ago for more than we expected in the business case, more rapidly than we expected, at a fantastic cap rate. And what we found is that the institutional investors, this is like an $80 million sales, gigantic complex that we built, are still paying top dollar for assets. What's not getting top dollar is the 30-year-old property that's been poorly maintained. So for the part of our fund where we're buying it's not a distressed property, but just like an old apartment that's tired and the market rents are like $400 or $500 below where they should be in the market, we're getting about a 6 or 8% discount on that purchase compared to what we would have paid this time last year. So the impact with all the market changes is that the premium assets that we're finishing up, we're still getting great prices. The buy sides on our fix-up properties, we're getting better prices. We're paying more on our interest rates. So what we're gaining on the buy side, we're giving back to the banks on the interest. It ends up being a push, and our returns are just about the same as they were 4 years ago.
And then the second part, I'm sorry, I was reading their comments. You may have answered this. Do the economic changes with the more apartment inventory affect any of the What's
Great
the
question.
returns there?
So we're sitting on a situation right now where the first time buyer pool is traditionally the guys who are between 20 and 34 years old. And we have more people in that age cohort right now than any time in American history. So we have more potential first time buyers than ever. And right now, everything is headwind to the first time buyer, the high interest rates, incredible appreciation in asset prices. So a lot of people who should be buying their first home right now can't. They've been priced out. So the number of renters is going to grow disproportionately faster than population growth for at least the next 5 or 6 years. So there's a lot of apartments under construction, and they're all going to get filled up pretty quick. As a landlord, it's great. As a first-time buyer, it's terrible.
All right, last couple questions here. Cynthia asks or says, my husband and I are full-time real estate investors with rental properties owned free and clear. With no W-2 income, should we anticipate problems refinancing rentals to take out equity in order to pursue option 2?
Great question. So if you go to a typical Fannie Mae lender, like your typical mortgage broker, I think the answer would be yes. I think that they're going to be heavily reliant on W-2. This is where the local banks, who can just kind of be intelligent in their underwriting, are going to find you to be a very attractive borrower. So you're probably going to pay like a half a point more than you would have on a Fannie Freddie refi, but you're going to have like infinitely more flexibility. It'll be worth it. And I can introduce you to some guys who are like common sense bankers who can like think and not just like follow the template blindly.
Yeah, and that's a great point where like reach out to the right lenders, and you have to talk to a few.
Yeah,
and
I'll make a couple introductions for you.
There's also local banks. There's also like more like the non-QM loan lenders as well, which will we've had a lot of clients. I forget what QM actually stands for. It's
I don't remember now either.
Basically a non-QM means you can't qualify through traditional channels like Fannie and Freddie.
Yeah, it's like the next best step.
Yeah, but hey, they look at your person, your bank statements, your assets. Oh, okay, we see you make very little money on tax returns, but you have $3 million in assets. You make $200,000 a year. Yes, we're happy to loan to you.
Yep.
They can just look things through a different set of eyes in Fannie and Freddie. So this is where like the local banks Lon talked about and some non-QM lenders can come into like your real estate investing team and reach out to us. We can we'll make a few introductions, and you should be able to find someone that works for you. And I think that's it for the questions. All right, so ladies and gentlemen, we appreciate so much. I mean, it is really cool to have 100 people on a webinar on Monday morning. We love this topic. We're going to do a lot more interactive webinars like this around investing topics because a lot of people have questions and need to know about it. So check out the Portfolio Analysis Mastermind registration here next few days. We'll send a follow-up email with the link recording, the slide deck, the spreadsheet, a couple general follow-up information as well. But most important, if you have any questions on investments, what to do, referrals, building out your team, reach out to us. We're happy to open up our network and give you whatever knowledge we can. And of course, Lon, thank you so much.
Thank you for having me.
You're very busy. You spent a couple hours this weekend preparing the slide deck because I got it like Sunday morning. So thank you for doing that. Much appreciated.
You bet. Thanks, guys, for being on the webinar with us.
Thanks, everyone.
Man, a lot of good